Welcome back to Research Expert Solutions. Today we're diving into an interesting study that looks at the impact of foreign direct investment, or FDI, on Zambia's economic growth over the past 25 years. This study was done by two brilliant researchers, Dumisani Ndlovu and Lubinda Haabazoka, both from the University of Zambia's Graduate School of Business. Now you might be wondering, what exactly is foreign direct investment, and why should we care about it? Well, in simple terms, FDI happens when a company or individual from one country invests in a business or project in another country. It could mean building factories, opening shops, or even helping local businesses grow. The big question here is, how does all this investment affect Zambia's economy? From 1996 to 2020, Zambia has been opening its doors to foreign investors, hoping that this will fuel economic growth. And here's the key part of the study. Does FDI actually contribute to Zambia's growth? Does it lead to more jobs, higher income levels, or better infrastructure? Or is it just another form of capital that doesn't really make a difference? So, what did Ndlovu and Haabazoka find out? Well, their study takes a deep dive into the data from the last 2 decades, examining how FDI flows into Zambia, what sectors it targets, and how it aligns with the country's growth objectives. They use data from the Central Statistical Office, government reports, and global databases, so they had a lot of information to work with. But before we get into the nitty-gritty, imagine this. If Zambia could harness the right kind of investment, would it mean more jobs for young people, better roads, and improved industries? That's the big hope, and these researchers are trying to figure out if it's true. Stay tuned, because next we're going to explore exactly how FDI has been impacting Zambia, both positively and negatively, over the years. We'll take a look at the key findings and understand what it really means for Zambia's future. Alright, let's dive deeper into the study by Ndlovu and Haabazoka on the role of foreign direct investment, or FDI, in Zambia's economic growth. This section is all about why FDI is considered such a big deal in today's global economy, and why so many countries, including Zambia, are interested in attracting it. The authors highlight that FDI has become a critical part of globalization, so much so that it has actually surpassed traditional trade in importance. Think about it, it's no longer just about buying and selling goods across borders. It's about companies setting up operations in other countries, bringing in capital, creating jobs, and often boosting local economies in the process. This growing role of FDI has led to tons of theories and models over the years to explain what makes FDI tick, why companies choose certain countries, why they use certain strategies, and how FDI impacts these host nations. One of the foundational ideas here is the Hexaline model, which Ndlovu and Haabazoka reference to explain the movement of capital across borders. According to this model, capital, money for investment, flows into countries where it can earn higher returns, which tend to be places where labor costs are lower. Imagine a company thinking, hey, if we set up in a country where labor is more affordable, we can produce our goods at a lower cost and earn more profit. Zambia, like many other nations, has become one of those destinations. The authors also bring up other factors that affect these decisions, such as exchange rate risk. When a company is considering investing in another country, they have to think about how the currency value might change over time. Countries with stronger, more stable currencies often attract more investment because foreign companies see less risk in those markets. But the big question here is, how does FDI actually help a country's economy? Ndlovu and Haabazoka refer to past research showing that FDI can drive economic growth in many ways. For one, it can bring in new technology and innovations. Think about all the tech that might be available in advanced economies. When foreign companies invest in Zambia, they might introduce some of these technologies, benefiting local industries. Additionally, FDI can help build a skilled workforce. When foreign companies set up shop, they train local employees, creating a transfer of skills and knowledge. Now, why does this matter for Zambia specifically? Ndlovu and Haabazoka suggest that FDI isn't just a short-term boost but a potential path to sustainable development. According to the World Bank, FDI can create lasting benefits, like fostering a competitive business environment, boosting human capital, and even helping integrate the country into the global economy. These are exactly the kinds of outcomes that could set Zambia up for long-term growth. which is why understanding FDI's impact here is so crucial. So, in this study, Ndlovu and Haabazoka aim to explore whether FDI has lived up to these promises in Zambia. They're looking into whether it has truly created jobs, raised incomes, and advanced technology in a way that benefits the country as a whole. Now let's jump into the background of this research by Ndlovu and Haabazoka. They set the stage by explaining why FDI, foreign direct investment, has become such a huge force in today's world. For decades now, FDI has been viewed as a critical link between economic growth and globalization, a way for capital and knowledge to flow from wealthier countries to those that are still developing. Countries around the world, including Zambia, are buying into this international FDI network, hoping it will bring all kinds of benefits. The authors reference experts who say that FDI brings essential resources to developing countries. Imagine a scenario where a multinational company decides to invest in Zambia, setting up facilities and bringing with it advanced technologies, management expertise, and entrepreneurial skills. This isn't just about money moving across borders. It's about sharing knowledge and capabilities that can help a developing economy like Zambia accelerate its growth. According to the OECD, FDI isn't just a quick injection of capital, it's about building long-term relationships. When a company from one country invests in a company in another country, with at least 10% ownership, it's not just dipping a toe in, it's establishing lasting interest. This means the foreign company has a significant influence on how the local company operates. So, FDI is all about these long-term partnerships, where the foreign company has a say and a stake in the future of the local economy. The World Bank has a similar definition. It sees FDI as a way to gain a lasting management interest in a foreign enterprise. And this lasting interest is key because it means the investor is committed to the host country's economy for the long haul, which often leads to the development of infrastructure, job creation, and a boost to local industries. And it's not just theory. Research has shown that FDI positively impacts economies in many ways. Studies from Rahman, Tiwari, Mutasku, and even Moyle, a local researcher, confirm that FDI contributes to national output, creates jobs, and more. Think of it as a boost not only to the country's GDP but to the lives of individuals through job opportunities and new skills. Barua, another researcher, argues that foreign capital supplements the funds available for investment in developing economies, which is critical when local resources are scarce. But FDI doesn't just bring money. It also introduces advanced technologies, cutting-edge machinery, and global marketing networks. Imagine having access to cheaper production methods and larger markets. That's a recipe for growth that many developing nations can't resist. But here's an interesting point. These benefits only materialize if the host country creates a conducive environment for investment. As Ndlovu and Haabazoka highlight, researchers like Ghoshal and Saxena have shown that FDI works best when the environment allows for stable, long-term links between economies. In such environments, foreign companies feel secure enough to invest in infrastructure, create jobs, and share knowledge. So, in essence, FDI isn't just a financial transaction. It's an entire system for economic development. The question that Ndlovu and Haabazoka now aim to answer is how this all plays out in Zambia specifically. How has FDI actually contributed to Zambia's economy over the years? Now, let's dive into the heart of the study by Ndlovu and Haabazoka. The problem they're trying to solve. Zambia has done a great job attracting foreign investors over the past decade, largely thanks to its reputation for peace and stability. This steady inflow of foreign direct investment, or FDI, has been significant, with numbers rising year after year. You'd expect this to be a clear win for Zambia's economy, right? But here's where it gets interesting. Despite the increase in FDI, Zambia is still facing high unemployment rates and a declining GDP. According to the World Bank, the unemployment rate has gone up from 7.85% to 13.20% in just a decade, and GDP has dropped from $25.5 billion to $21.2 billion over the same period. This is a surprising turn, hinting at some deep-seated issues in the economy. So, Ndlovu and Haabazoka set out to explore the real impact of FDI on Zambia's economic performance. Yes, there are growth theories out there that tout the benefits of FDI, like Alyasania's 2013 work, which supports the idea that FDI contributes to investment and growth. But the reality is more complex and even controversial. For every study that says FDI boosts economic growth, there's another that challenges this. Some researchers, like Egbo, Alcasona, and Moyo, have found positive links between FDI and growth. Meanwhile, others like Atari have reported the opposite, a negative relationship between FDI and economic growth. What this conflicting evidence shows is that FDI's role in development isn't a one-size-fits-all answer. These contradictions make it essential to zoom in on Zambia's unique experience with FDI and see what's actually happening on the ground. That's exactly what this study aims to do, bring clarity to these controversies in a Zambian context. To structure their research, Ndlovu and Haabazoka have outlined 3 key questions. First, they're asking, what's been the trend of FDI in Zambia from 1996 to 2020? This will help us understand how FDI has evolved over time and set the context for its impact. Next, they're looking at the effect of FDI on economic growth in Zambia during this period. And finally, they're exploring ways to enhance economic growth through FDI inflows. This study isn't just about crunching numbers. It's about finding actionable insights that can help shape Zambia's economic policies moving forward. In the next section, we'll dive into their methodology and see how they've designed this research to tackle these questions. Stick around, there's a lot more to unpack. Alright, so now let's look into what the literature has to say about foreign direct investment, or FDI, which Ndlovu and Haabazoka reviewed in depth. Foreign direct investment is essentially when a company from one country invests in another country, usually with the goal of establishing a long-term stake in that foreign enterprise. The United Nations Conference on Trade and Development, or UNCTAD, explains that these investments usually lead to some level of ownership or influence in the host country, making FDI different from just moving capital across borders for quick gains. The World Bank points out that FDI isn't just about money flowing in. It often brings other benefits like jobs, competition, and knowledge sharing. This is especially true for developing countries, which tend to rely on FDI as a major source of funding. Why? Well, researchers like Mawila and Nyambi say that FDI can really transform labor markets, helping to boost skills and productivity through training and technology transfer. And this has encouraged many developing countries to actively seek out FDI, seeing it as a path to financial independence from donor policies. Yunus and his team add another layer to this by arguing that trade openness is key. They believe that for a host country to really harness the benefits of FDI, it needs open trade policies that allow for a free flow of goods and services. Ndlovu agrees, suggesting that FDI uses advanced integration strategies, which means it depends on access to a wide range of imported materials to keep things running smoothly. But it's not all positive. Some studies warn about potential downsides, such as what Yusuf and Hung call the crowding out effect. This happens when multinational corporations overshadow local businesses, which often can't compete due to limited resources. Dogan sheds light on why this happens. Local companies in developing countries are often unable to make the large-scale investments that foreign companies can afford, especially when it comes to research and development or harnessing natural resources. And while many countries do offer tax breaks and incentives to attract FDI, Mavrodas and colleagues caution that FDI should ideally support local businesses rather than pushing them out of the market. According to the OECD, FDI holds the potential to support sustainable growth. They suggest that FDI can lead to positive spillovers like technology transfers, improved human capital, and even greater competitiveness in the host country's business environment. On top of that, UNCTAD emphasizes FDI's reliability as a long-term financing source since it's generally based on a strategic evaluation of the host country's economy, resources, and market potential. This is especially relevant for Africa, and here's why. In sub-Saharan Africa, financial markets are often underdeveloped, and internal resources are limited, which makes FDI crucial for filling the funding gap. Without enough internal funding, these economies struggle to support their domestic investment needs. So, FDI becomes a tool for boosting growth, job creation, and poverty reduction. UNCTAD's 2013 report highlights this point, noting that most African countries have put in place policies to lower barriers to FDI to attract these investments. Finally, a major debate in African economic circles has been about why FDI is primarily attracted to resource-rich or larger economies on the continent. This debate has only intensified over the last decade, especially as we've seen increased demand from growing economies like China and India. which are eager for Africa's natural resources. Brodigam and Gallagher, along with Brown, have noted that these trends are shaping the future of FDI in Africa, raising important questions about its long-term impact. Alright, so now let's dive into what the authors, Ndlovu and Haabazoka, found when they explored the concept of economic growth. This topic, as they highlight, is central to understanding the broader economic health of any nation. So, what does economic growth mean exactly? Well, Sengupta and Titus, 2011, give us a good foundation here. They describe economic growth as the long-term increase in national income or other standard of living measures, like the Human Development Index, or HDI. Essentially, it's about the gradual rise in a country's wealth and well-being over time. Suprianto, 2016, takes it further, arguing that economic growth is one of the most straightforward indicators of how active and healthy a country's economy is. Meanwhile, GI and colleagues, 2019, suggest that if we're to truly understand economic growth, we need to grasp not just what grows, like GDP, but also why and how it grows. They emphasize that knowing which variables drive GDP growth is critical for a complete picture of economic health. But here's where things get interesting. Pitak, 2015, makes a crucial point. While economic growth is often a go-to measure of wealth, it doesn't always capture the full story of people's lives. He explains that GDP might rise without reflecting true improvements in living standards for everyday citizens. So, while growth numbers might look great on paper, they don't always tell us if people are really better off. Next, let's look at Sukarno, 2017, who defines economic growth specifically as a rise in GDP, gross domestic product. He makes an intriguing observation. Wealthy nations often talk about economic growth, while developing nations might refer to this same rise in GDP as economic development. And why is this distinction important? Because in many developing countries, economic growth isn't just about wealth, it's about improving lives and reducing poverty. According to Suprianto, 2016, economic progress in a country can be measured in many ways, like through state income, income per capita, employment rates, and how much poverty is reduced. And Sengupta, 2011, adds that economic growth has both an output side, where goods and services are consumed, and a cost side, which includes the resources and costs involved in producing these goods. So, how do we actually measure economic growth? According to the OECD, 2015, indicators of economic health include national savings, production levels, foreign trade, and the prices of goods. But Gary and Villarreal, 2016, argue that it's not just about dollars and trade figures. They say economic growth can also be measured by social indicators, like life expectancy, income distribution, gender equality, and access to essentials. Meanwhile, economic indicators like employment rates, inflation, trade, GDP, and GNP show us the more traditional, financial side of growth. Ndlovu and Haabazoka guide us through all these perspectives to give us a well-rounded understanding of economic growth, showing that it's not just about the numbers but about what those numbers mean for people's lives. Alright, now let's dig deeper into the determinants of economic growth, those critical factors that shape a country's economic trajectory. This time, the insights come from a comprehensive study conducted by Chirwa and Odiambo, 2017, and let me tell you, they really break it down for us. So, what did they uncover? In developed nations, trade, demographic changes, monetary policy, physical capital, fiscal policy, human capital, and financial and technological advancements emerge as the major macroeconomic drivers of growth. Think of these as the big gears that keep the economic engine running smoothly. And let's not forget what the World Bank, 2015, reminds us: productivity factors, like technological innovation, and the accumulation of physical and human capital are central to almost every country's economic success. It's not just about having resources, it's about using them wisely and investing in people. But wait, the plot thickens. Bhaskar Rao and Hassan, 2011, give us a fascinating case study from Bangladesh. Their research, spanning nearly 4 decades, showed that while government expenditure and inflation hindered growth, reforms since the 1980s, foreign direct investment, FDI, money supply, and trade openness gave the economy a serious boost. It's a great reminder that good policies and openness to global trade can pay off. Big time. Now, let's jump to Africa, where Chang and Mendy, 2012, explored 36 nations over nearly 30 years. Their findings? Well, it's a mixed bag. On the bright side, economic growth was positively linked to foreign aid, exports, imports, employment, and trade openness. But here's the twist. Factors like FDI, domestic investment, and gross national savings actually had negative effects. Even foreign aid's impact wasn't consistent. It varied across regions. For instance, it worked wonders in the Middle and North African regions but had adverse effects in West and East Africa. Interesting, right? It shows how complex and context-dependent these relationships can be. And finally, we can't overlook Ndlovu's 2014 work comparing growth determinants in Africa and China. In Africa, he found that factors like domestic investment, official aid, secondary school enrollment, good governance, and urbanization were all growth-friendly. But in China, a slightly different story unfolded. While domestic investment and trade openness spurred growth, other factors, like inflation, credit to the private sector, and even agricultural and oil prices, acted as growth bottlenecks. So, what's the takeaway here? Economic growth isn't a one-size-fits-all formula. Whether it's the role of governance, education, trade, or technology, the story varies from one country, or even one region, to the next. And that's exactly what makes this topic so fascinating to explore. Stick around as we continue this journey through the complexities of economic growth. There's a lot more to uncover, and trust me, it only gets more interesting from here. Alright, let's talk about the fascinating studies that have explored foreign direct investment, FDI, and its impact across sub-Saharan Africa. These insights are brought to us by several experts whose work paints a complex and varied picture of FDI in the region. Let's break it down. First, we've got Zambia, 2012, who takes a deep dive into what attracts FDI to sub-Saharan Africa. His findings? It's all about creating the right environment. He argues that improving infrastructure, fighting corruption, enforcing laws, and eliminating socio-political violence are essential steps to boost FDI inflows. Interestingly, Zambia didn't focus on what FDI does for the economy but instead zeroed in on what it takes to get investors interested in the first place. Next up, EAFJ, 2011, took a slightly different approach, analyzing how FDI interacts with human capital. He looked at 24 SSA nations over 36 years and found that while FDI and its interplay with human capital had a favorable effect on economic development, the results weren't statistically significant. EAFJ also highlighted a critical point. Countries with lower skilled labor forces tend to attract less FDI. But one limitation here was the dated data, spanning from 1970 to 2006. That definitely calls for more updated research. Now let's talk about Haabazoka, 2012, who explored the dynamic relationship between economic growth, savings, and FDI. Using data from 1977 to 2010, Haabazoka found some intriguing causal links. One ran from FDI and savings to GDP growth, while another ran the opposite way, from GDP growth and savings to FDI inflows. It's like a feedback loop. Growth fuels investment, which in turn drives more growth. Pretty cool, right? Moving on, Ndlovu and Somer, 2012, took a unique angle, looking at how FDI impacts well-being, especially poverty reduction, across 52 African nations. They used the Human Development Index alongside FDI net inflows per capita to measure outcomes. Here's the catch. While FDI had a significant positive impact on reducing poverty in Central and East Africa, the effect was less pronounced in North and Southern Africa, and unclear in West Africa. These results remind us that the impact of FDI isn't one-size-fits-all. It varies greatly by region. But again, the data is a bit dated, covering 1990 to 2007, highlighting the need for more recent analysis. And here's where things get even more interesting. Lutz and Kabundi, 2012, as well as Ndlovu, 2012, looked at the role of natural resources in attracting FDI. Both studies found that resource-rich nations in Africa see a significant positive impact on FDI inflows. However, these studies also relied on older data, making their findings ripe for re-examination in today's context. Finally, let's zoom in on Zimbabwe and Nigeria. Moyo, 2013, used a multiple regression model and found that FDI had a very significant positive impact on Zimbabwe's economic growth. Meanwhile, Egbo et al., 2011, used Granger causality tests to show that FDI also spurred growth in Nigeria. But here's the thing. While these findings are encouraging, neither study focused on Zambia. And let's be real, Zambia has its own unique economic and cultural dynamics. So, while these studies offer valuable insights, their results might not directly apply to Zambia. In summary, these studies highlight the diverse ways FDI interacts with economies across Africa. From improving infrastructure to reducing poverty, FDI can be a game changer, but its effects depend heavily on the local context. That's why there's a need to dive deeper into Zambia's specific case. Stay tuned, because this story is far from over. Alright, let's dive into the heart of this research, the variables and hypotheses section. The authors of this study, whom we've been following closely, anchored their work on a classic economic theory, the Haabazoka growth model. Now, if you're not familiar with it, don't worry. This model is all about understanding how investments, like foreign direct investment, FDI, can potentially drive economic growth. Exciting, right? So here's the big question. Did Zambia's cumulative FDI receipts from 1996 to 2020 significantly impact its economic growth? That's what the researchers wanted to uncover. And to explore this, they built a conceptual framework with FDI as the independent variable and four dependent variables: interest rate, inflation rate, unemployment rate, and national savings rate. Let's break it down. In this study, economic growth wasn't measured in the traditional sense of just GDP growth. Instead, the researchers got creative. They looked at changes in unemployment, national savings, interest, and inflation rates as indicators of economic growth. Talk about a fresh perspective. Now, onto the hypotheses. And this is where it gets really interesting. For each of the dependent variables, the researchers formulated hypotheses to test whether FDI had a meaningful influence. Let's walk through them. Unemployment rate. The null hypothesis, or H, suggests that FDI inflows as a share of GDP have no positive effect on Zambia's unemployment rate. But the alternative hypothesis, H, argues that FDI does, in fact, positively influence unemployment, potentially creating jobs and reducing joblessness. National savings rate. H claims there's no positive relationship between FDI and the national savings rate. Meanwhile, H2 challenges this, suggesting that FDI could actually bolster national savings, perhaps through increased income and investment returns. Interest rate. H proposes that FDI has no positive influence on interest rates. H3, however, suggests otherwise, implying that FDI could drive interest rates higher through mechanisms like increased investment demand. Inflation rate. Here's an intriguing twist. H suggests no negative relationship between FDI and inflation, but H4 takes a bold stance, arguing that FDI might actually reduce inflation, perhaps by improving productivity and stabilizing prices. This conceptual framework, as laid out in the study, paints a comprehensive picture of how FDI could interact with key economic indicators. And remember, the hypotheses weren't just written to fill up space. They were rigorously tested using the data from 1996 to 2020. So, what do you think? Does FDI really have the power to shape a country's economic destiny in these ways? Stick around, because we're going to explore the results of these hypotheses and see what the data says. Trust me, it's going to be eye-opening. Alright, everyone, let's dive into the results and discussion section of this fascinating study, specifically looking at Model 1. The focus here? The relationship, or lack thereof, between FDI as the independent variable and interest rates as the dependent variable. Intriguing, right? Let's break it down. To start, the researchers first tackled stationarity, a fancy way of saying they checked if the data was stable over time. Both FDI and interest rates turned out to be stationary at their first differences. That's a critical checkmark because stationarity ensures the data behaves predictably enough to apply advanced statistical tests. Using unit root tests, they confidently rejected the idea that the data wasn't stationary at this level. That's an important box ticked for valid results. Now, here's where it gets really interesting. They used what's called the bounds test. This method checks for long-term relationships between variables, even when some variables might be stationary while others are not. The null hypothesis? It assumes there's no long-term connection between FDI and interest rates. The alternative hypothesis? Well, it suggests the opposite, that there is a relationship. When the researchers ran this test using eViews, they got a key result. The F statistic was 2.219. Now, this number might not mean much at first glance, but here's the kicker. It didn't exceed the critical threshold for significance at the 5% level. Translation? The null hypothesis stands. There's no long-term relationship between FDI and interest rates. So, despite the theories out there suggesting otherwise, this study says, not so fast. But wait, there's more. The results did reveal something intriguing in the coefficients of the long-run equation. Specifically, a 1% increase in FDI appeared to lead to a 0.483% rise in interest rates. While this might sound like a connection, the statistical analysis concluded it wasn't significant enough to call it a long-term trend. In simpler terms, the numbers hint at a relationship but don't shout it loud enough for us to confirm. So, what's the takeaway here? According to these findings, there's inadequate evidence to support a strong, long-lasting relationship between FDI and interest rates. This adds an intriguing layer to the global discourse because, as we've seen from past studies by researchers like Muhammad, 2014, and Ahmad, 2013, FDI often gets linked to major economic outcomes. But here, not so much for interest rates. Alright, that's the scoop for Model 1. Ready to dig deeper? Let's keep this momentum going with more findings from this study. Stay tuned. Alright, folks, let's get into the nitty-gritty of how this study was conducted. Trust me, this is where the magic of research really comes to life. Now, the researchers, who we've been following closely, chose the positivism research philosophy to guide their work. Why? Because they wanted to stay grounded in objective, measurable truths, avoiding any subjective interpretations. That's where the deductive research approach comes in. It's all about testing theories and working down from the big picture to the specific details. And what's more, they adopted a causal/correlational research design, which means they weren't just looking for patterns. They were diving deep into cause and effect relationships. Their unit of analysis? Entire countries. Pretty ambitious, right? They examined annual records between 1996 and 2020, covering a rich dataset that spanned decades. The population for this study was a treasure trove of secondary data sourced from some of the most reputable organizations. Think UNCTAD, the World Bank's World Development Indicators, the IMF, and the OECD. Basically, they left no stone unturned. Now, let's talk data analysis. This is where things get technical, but I'll break it down for you. They used time series annual data for the 24-year period and applied a multiple regression model to uncover relationships between variables. But before diving into the analysis, they checked for stationarity in the time series using unit root tests, a crucial step to ensure the data was suitable for reliable analysis. To ensure their findings were statistically sound, they tested for normality using measures like skewness, kurtosis, and the Jark-Barra tests. Essentially, they wanted to make sure their data wasn't skewed or abnormally distributed. It's like checking the foundation before you build the house. For the actual testing, they employed time series analysis to evaluate their hypotheses. And here's the tech twist. They used eViews 10 to estimate something called the autoregressive distributed lag (ARDL) model. This approach is perfect for analyzing relationships when variables don't all behave the same way. Some might be stationary, others might not. Now, what were they analyzing exactly? The key variables included FDI as a percentage of GDP, national savings, inflation, interest rates, and unemployment rates. These indicators were the building blocks of their analysis, painting a detailed picture of the economic environment. So, what's the takeaway here? This methodology was not just rigorous but also incredibly thorough. By combining cutting-edge statistical techniques with reliable data sources, these researchers set the stage for insights that could significantly influence how we understand FDI. And don't worry, we'll unpack those findings soon. So stay with me. Alright, let's dive deeper into the fascinating details of Model 2. where the authors of this study analyzed the inflation rate and its implications. This is where the story takes on a more quantitative twist. And trust me, the insights are just as captivating as they are data-driven. So, here's the setup. The researchers began by presenting descriptive statistics for the variables they used to estimate their model. Now, what's cool about this approach is how they explored not only the raw numbers but also what those numbers mean, especially in the context of predicting behavior. And the behavior in question? Timely tax return submission. Let's unpack this. The study examined 6 key factors to understand how they might influence the likelihood of taxpayers submitting their tax returns on time. These factors were economic efficiency, administrative simplicity, equity, flexibility, certainty, and political responsibility. The researchers didn't just pluck these out of thin air. Each factor was carefully assessed on a 5-point Likert scale, with 1 meaning strongly disagree, and 5 meaning strongly agree. By the end of this analysis, they created a dependent variable that captured whether taxpayers submitted their returns on time. 0 meant late submission, while 1 represented early or timely submission. Now, here's where the data starts speaking. The mean score for timely submissions was 0.509, suggesting taxpayers were slightly more likely to file on time. But hold on. The standard deviation of 0.501 tells us there was quite a bit of variation in submission behavior. The distribution? Almost symmetrical but leans slightly negative, and the kurtosis value indicated a flatter than usual peak. In other words, there was a pretty broad spread of submission habits across the sample of 159 taxpayers. When it comes to the predictor variables, the story gets even more intriguing. Let's take a closer look. Economic efficiency had a mean score of 3.006, sitting right around the midpoint. Factors like certainty, 3.031, and political responsibility, 3.126, scored just above the median of 3, suggesting taxpayers lean toward agreement on their importance. On the flip side, administrative simplicity, 2.874, equity, 2.855, and flexibility, 2.975, fell slightly below the median. But here's the kicker. Despite these differences, the distributions of these factors were all roughly symmetrical. Skewness values hovered between -0.067 and 0.097, which means there wasn't much of a tilt in perceptions. Meanwhile, the kurtosis values confirmed relatively flat peaks, suggesting taxpayers' views on these factors weren't tightly clustered around the average. So, what's the takeaway? Well, this analysis reveals some intriguing patterns about how taxpayers perceive the efficiency and fairness of the tax system, and how those perceptions might shape their behavior. But we're not done yet. The real magic lies in how these factors interact with broader economic variables like inflation rates in this model. Ready for the next chapter of this analysis? Stick around, because there's more data-driven storytelling to uncover. Let's shift gears and dive into Model 3, where the spotlight is on foreign direct investment, FDI, and its connection to the unemployment rate. This part of the study by the authors is particularly exciting because it addresses one of the most critical challenges for any economy, employment. Now, here's what the researchers did. They identified FDI as the exogenous variable, essentially, the influencing factor, and unemployment rate as the endogenous variable, or the one being influenced. To make sure the data was up to scratch, they ran unit root tests to determine stationarity. Both variables showed stationarity at the first difference level, which is a fancy way of saying that they were ready for the next step, the bounds test. Now, why is this bounds test important? Well, it helps determine if there's a long-term relationship between FDI and unemployment, even when some data points are stationary and others aren't. It's like using a magnifying glass to spot patterns over time, patterns that might not be immediately obvious. The authors also used an autoregressive distributed lag, ARDL, model to pave the way for this bounds test. Why ARDL? Because it's perfect for analyzing datasets where variables behave differently, some stationary, some not. This model allowed them to assess whether FDI and unemployment are linked in the long run. Here's where it gets interesting. The test starts with a null hypothesis, suggesting there's no long-term relationship between FDI and unemployment. But, and this is the big reveal, the test results challenge this assumption. Using advanced tools like the co-integrating form and the bounds test in EAFJ software, the researchers were able to uncover some fascinating insights about these variables. What did they find? Well, stay tuned. The detailed results of this analysis are coming up next, and trust me, they paint an intriguing picture of how FDI interacts with employment rates over time. Don't go anywhere. There's more to unravel. Let's dive into Model 4, where the spotlight is on the relationship between foreign direct investment, FDI, and the national savings rate. The researchers are exploring how FDI could impact national savings, and the results are truly insightful. Now, the first thing we need to understand is the concept of stationarity. In simple terms, stationarity is all about whether the data behaves consistently over time. No crazy spikes or drops. For this model, both FDI and national savings were stationary at the first difference. This means that when you subtract the data points from one period to the next, they show a steady trend. Super important when applying advanced statistical tests. Speaking of those tests, the unit root tests were used on the first differences of both FDI and national savings. The results were crystal clear. The null hypothesis, which suggested the data is stationary at the first difference, was rejected. Why is this a big deal? Well, this rejection is key because it opens the door to using the bounds test, a powerful tool that helps us figure out if there's a long-term relationship between FDI and national savings. The bounds test works by checking for long-run relationships among different time series data, even if some of the data sets are stationary and others are not. It's a bit like putting together a puzzle with pieces that don't all look the same but still fit perfectly together in the end. So, by applying this test to the ARDL model, autoregressive distributed lag model, the researchers are trying to see if FDI truly has a lasting impact on how much a country saves. The null hypothesis here is pretty simple. There is no long-term relationship between FDI and national savings. But with the application of the co-integrating form and bounds test in EAFJ software, the researchers set the stage to either confirm or reject this idea. Are we about to see a new insight into how FDI could potentially influence a nation's savings habits over the long term? Stay with us because the results are coming up, and they could change the way we think about investment and savings strategies in Zambia. Alright, let's dig into Table 4, where we're looking at the results of the bounds test for the relationship between foreign direct investment, FDI, and national savings. The researchers conducted this test to uncover if there's a lasting, long-term connection between these two variables. Now, when we take a look at the F statistic, we see it's 0.810. And here's the kicker. This value doesn't quite exceed the critical value for the 5% lower bound. What does this mean? Simply put, the evidence isn't strong enough to reject the null hypothesis, which claims there's no long-run relationship between FDI and national savings. So, in plain language, the data suggests that FDI might not have a lasting impact on how much a country saves. But hold on, there's a twist. The study still gives us something to think about. The results also show that a 1% increase in FDI leads to a 0.219% increase in national savings. While this seems like a small effect, it's still worth noting. The key takeaway, though, is that the overall conclusion doesn't support the idea of a long-term connection between FDI and national savings, especially with a p-value greater than 0.05. So, based on these findings, the researchers, who I remind you, are deeply focused on this important issue of economic development in Zambia, are suggesting that while FDI does have some short-term impact on national savings, it doesn't appear to create a long-lasting relationship. Pretty fascinating, right? These results are all part of a broader investigation into the role FDI plays in shaping the economic landscape. But as we've seen, the long-term influence might not be as significant as we once thought. Let's take a moment to wrap things up and reflect on the hypotheses tested throughout the study, as summarized in Table 5. The results of these tests have helped us uncover some pretty interesting findings about the role foreign direct investment, FDI, plays in Zambia's economy, specifically between 1996 to 2020. So, what did the researchers find after examining all four models? Well, here's what the data showed. First, when it comes to annual interest rates, FDI didn't seem to make a significant impact during that period. In other words, FDI wasn't a driving force behind changes in interest rates in Zambia. Second, the study also revealed that FDI didn't have a significant effect on the unemployment rate in Zambia from 1996 to 2020. This might surprise some of us because, traditionally, we think that more foreign investment creates jobs, but the data here says otherwise. Moving on to national savings, once again, FDI didn't show a significant effect on the national saving rate during those years. So, despite the influx of foreign capital, it didn't lead to a measurable increase in how much the country saves. However, there was one key finding that stood out. FDI did have a significant effect on annual inflation rates in Zambia over the same period. This suggests that foreign investments can influence the cost of living in the country, driving inflation rates in a noticeable way. Now, this summary brings us to a crucial point. The authors of this study have shed light on the fact that while FDI plays a critical role in shaping some aspects of Zambia's economy, its impact on things like unemployment and national savings is less significant than we might have expected. So, even though FDI is still an important economic player, its effects aren't as universal as we might assume. It's a fascinating outcome that underscores the need for policymakers to take a deeper look at how FDI interacts with different economic variables. Alright, now let's take a step back and dive into the policy implications that come out of this fascinating study by Ndlovu and Haabazoka, 2024. Their research provides some valuable insights that Zambia's policymakers should definitely take note of if they want to drive long-term economic growth. So, based on the findings, there are a few key areas where foreign direct investment, FDI, really plays a significant role in Zambia's development, and the government should pay close attention to these patterns. First off, from 1996 to 2010, FDI in Zambia grew significantly, driven by liberation motivations. But between 2010 and 2020, something changed. The study shows that FDI started to decrease, largely due to Zambia's economic performance. The key takeaway here is that the government can't just wait for FDI to flow in naturally. They need to actively monitor and manage these trends. FDI isn't automatic. There are factors that encourage or hinder it, and it's up to the government to understand both sides of the equation. And here's an interesting twist. The mining sector, which has been a major driver of FDI in Zambia, faced a lot of challenges in the past decade, mainly around resource abundance. As a result, FDI in the mining sector dropped. So, what should the government do? According to Ndlovu and Haabazoka, 2024, it's time to diversify. They recommend that the government focus on encouraging FDI in other sectors like agriculture, manufacturing, and energy, areas that hold a lot of untapped potential for economic growth. These sectors might not be getting as much attention as mining, but they can be just as vital for Zambia's future. Now, let's talk about FDI and unemployment rates. The research found that FDI doesn't significantly affect unemployment in Zambia. However, the relationship is still negative, meaning that FDI could help reduce unemployment in the long run, even if it's not immediately obvious. Why is that? Well, often, FDI projects bring their own specialized labor, which means local workers might not benefit directly from those investments right away. So, what's the fix? Ndlovu and Haabazoka, 2024, suggests that the government should invest in education and training programs to ensure that Zambia's workforce is skilled enough to meet the demands of FDI projects. Think engineering, actuarial science, and other specialized fields. The more specialized the workforce, the more Zambia can benefit from FDI. And now, the big takeaway. The study shows that FDI helps to reduce inflation in Zambia. This is a game changer because inflation control is one of the key indicators of a healthy economy. So, what does the government need to do? The study suggests that the government should create an enabling environment for FDI by maintaining political and economic stability. A stable environment will help attract even more FDI, which will, in turn, lead to greater economic stability. In conclusion, Ndlovu and Haabazoka, 2024, emphasize the need for policies that not only attract more FDI but also ensure that the benefits are felt across various sectors, with a workforce that's ready to take on the challenges of the modern economy. Before we wrap up, don't forget to subscribe to our Research Expert Solutions YouTube channel. By subscribing, you'll stay up to date with all our latest reviews and analyses of research papers like the one we've just discussed from Ndlovu and Haabazoka, 2024. We're dedicated to bringing you in-depth insights into important research topics, especially those impacting Zambia's development. So hit that subscribe button and join us on this exciting journey of exploring research that shapes our future. And hey, if you have a research paper or journal article in mind that you'd like us to review in one of our upcoming videos, we'd love to hear from you. Just drop the author's name and research topic in the comments below. If possible, leave a link to its webpage as well, and we'll make sure to check it out and possibly feature it in our next video. Your input matters, and together, we can dive deeper into even more exciting research.